You learn 10 times more about real estate and investing when things are going wrong than you ever learned when things are going right. So that's been a big part of my career, actually. But I've been fortunate to navigate my way through all of that stuff without ever losing a dollar of investor principal.
Welcome to Truly Passive Income. I'm Neil Henderson.
And I'm Clint Harris. And our guest today is Brian Burke. He's the founder and CEO of Praxis Capital. It's a real estate private equity firm with a remarkable 35-year track record. He was doing it way before it was cool. He's raised over $350 million and managed more than $800 million in assets, including over 4,000 multifamily units. Brian's book, The Hands-Off Investor, is a go-to guide for anyone looking to invest passively in real estate. Today, he's here to share insights into market cycles, how to navigate today's challenges, and the key to successful passive investing. Brian, thank you for being here. How are you today?
I'm great, guys. Thanks for having me here.
That's
Absolutely.
Awesome. Thank you. Listen, there's a lot to go through. You got a very impressive career track record. But for those that don't know anything about you, please tell us a little bit about yourself, how you got started, and some of the history of what you've been through.
Well, I started in the real estate investing world when I was 20 years old, and I knew nothing. I had nothing. I knew no one could rub more than two nickels together. And, I figured if you know nothing and have nothing, why not invest in real estate? So I started out as a small-time house flipper, and I did that for about a decade and grew my business organically over time, got into a pretty high-volume house flipping business, which turned into a multifamily business, which turned into a very large multifamily business, and kind of all around real estate. I think I've had my hands in almost every real estate sector. As I've done single family, multifamily, hotels, self-storage, vacant land, residential subdivisions, new home construction. And now we're even doing senior housing and skilled nursing and assisted living. So it's been a really interesting, wild career, but it took 35 years to pack all that in there. So it's been a little while.
Wow. Yeah, that's a lot going on in that same amount of time. I mean, the traditional path is people start slow, take a few licks, take it on the chin a little bit, and then slowly progress to the next thing. What do you think are some of the things that contributed to you being able to move that quickly and understand, obviously, fundamentals that can play across multiple different asset classes in that space? Like, what's the drive or what's pushing you forward that allowed you to kind of navigate that?
Well, I think my story is no different than that, Clint. I've definitely been through some really rough patches. The great financial collapse of 2009 was extraordinarily painful. And I think that that's a necessary part of anybody's natural growth in the real estate business. And kind of the more licks you take, the better you get. And, I've always said that you learn 10 times more about real estate and investing when things are going wrong than you ever learned when things are going right. So that's been a big part of my career, actually. But I've been fortunate to navigate my way through all of that stuff without ever losing a dollar of investor principal. And I think that's extraordinarily important. Paying attention to the risks and appreciating those risks, and timing the market certainly helps. I know people say you can't do that, but I've managed to pull it off several times. If you're really paying attention, you can make tactical and strategic moves that improve your position and protect your downside. And I think by doing all those things, it's allowed me to do all the stuff I just listed off. And I think that's just an important part of your growth path.
Brian, I first became aware of you back on the Bigger Pockets forum days, way back when, in like 2017. You were a bit of a staple on the forums. And you always struck me as a bit of a contrarian when everyone was entering the multifamily space back then. And you were just kind of like, you weren't nasty about it, but you were always kind of the guy that I remember was like, hey guys, this is not easy. Like if you guys are all jumping in on this, like, and some of you have never even, sounds like you've never even bought a single family rental before. I'm curious. We'll get deep into sort of what's going on with multifamily right now, but I know for a fact that you sold off a large percentage of your portfolio, sort of right before we had this latest crash with multifamily. What were the signs that you were seeing that made that move comfortable for you?
Well, it's funny when you say way back in 2017, because I think I joined Bigger Pockets in 2012, and I've been posting on there ever since and started investing in real estate in 1989. So 2017 is almost like day before yesterday.
But it does feel like a long time ago.
It does feel like a long time ago. And yeah, all that stuff that you said that I said, I probably said. That sounds exactly like what I would have said at the time. I tend to look a lot at the psychology of the market. Some people get really hyper focused on, this metric or that measurement or this percentage or cap rates or whatever other thing. And I think people focus on that because it's easy to quantify. If somebody says cap rates are 5%, you know what that means. Cap rates are 5%. And if they say that they decompress to 6%, you know what that means. It's numerically calculable. What's not numerically calculable is kind of the pulse of the market, really. What are investors thinking? And I try to look at the opposite story. When everybody knows something to be true, maybe it's time to think about the other side of the coin of like, well, what if it's false? Case in point, when you look at what was happening in the market in 2020 and 2021 after COVID, it went absolutely berserk in the multifamily space. I mean, buyers were buying anything they could get their hands on at any price. Properties were getting bid up millions of dollars over their so-called whisper prices. Cap rates were getting crunched down into the 3% range, which if you don't know what that means, it doesn't mean anything good. It means that people are paying way too much. And, when I saw that happening, you got to think of the other side of the story, which is like, well, what if all these people are wrong? Then what's going to happen? Well, what's going to happen is all these prices are going to come crashing down. So I think the best time to sell them is when everybody wants them. So we received an unsolicited offer on a property that was millions of dollars more than we ever would have imagined we would have sold it for if we would put it on the market. And, my thought was like, if somebody really wants it that bad, why should I stop them? They should have it. and they did. We sold it. And then I started thinking like, okay, let's see what happens if we put some other properties in the market and see if we get a similar response. And when you do, you kind of know that the buyers are capitulating and they're just buying anything and everything at any price. And that is a great time to be a seller. It's a really awful time to be a buyer, but it's a great time to be a seller. So that's how we sold 3/4 of our portfolio. We sold 3,000 units in 21 and 22, early 22. Come second quarter of 22, the market fell off a cliff because guess what? All those buyers were in fact wrong. Interest rates went up, rent growth fell, new apartment deliveries were at all-time highs, and it was a total mess. The prices have fallen, I think, 40 to 50%. The data won't prove that, but that's really what I think, that real values from peak to trough fell 50%. And I didn't need to ride that all the way down. I can buy back in when the bottom has kind of completed its process.
We talk to, usually it's kind of one or the other. It's not always both. We talk to people that have been doing real estate for a long, long time. And a lot of times, I don't mean this in a derogatory way, but sometimes it's a one-trick pony. Like they found their strategy early on. They've been doing the same thing for a really, really long time. We also talk to investors that have bounced around and done a lot of different things. It's very rare that we found someone who's bounced around and done a lot of different things for a really long time. Because a lot of times something hasn't worked out for one or both of those investors. But to have both of those facets, the tremendous amount of experience in terms of like market saturation and the different assets that you've gone after, but also have been doing it over decades. And to hear that you've never lost any of your investors' principles is astounding to me, especially after the last few years. That's incredible. So kudos on that. Where do you think that gut instinct comes from, especially with what you saw in 2021, 21, 22? You made a change where the market was screaming, and instead of being part of the demand, you recognized it and you flipped and decided to become part of the supply in an environment where everyone wanted to be part of the demand and nobody wanted to be part of the supply. Does that gut instinct come from having gone through this before in 2008, 2009? Or did you get it right back then as well because you look at things differently?
I think, I don't know, maybe I was born with it. I'm not really sure exactly where the intuition comes from. I think I listen, I read a lot. I absorb a lot of information and try to come up to my own conclusion. And a lot of times my conclusions are very counter to the popular narrative. And maybe that's contributed to it. I mean, so when I was in high school, I thought I was going to be an airline pilot. So I started taking flying lessons and learned how to fly an airplane. And I've been flying airplanes ever since. So I'm going on, I don't know, almost 40 years flying airplanes. And the key thing to do before you ever take flight in an airplane is inspect the hell out of that thing, because that airplane is trying to kill you. And your job is to figure out what trick it has up its sleeve to execute its mission. And I look at real estate kind of the same way. Is, when I'm doing my pre-flight inspection on my real estate strategy, I want to know, what is it in this real estate strategy that's going to try to kill me, and how do I avoid it? And when I hear the engine starting to sputter, it's time to get on the ground. And those instincts, I think, carry over into real estate and have helped me navigate these markets. Now, and don't get me wrong, you asked a really great question about people that, they kind of stick to one strategy, and then there's other people that bounce around. And, I've kind of done both. I bounced around a lot early in my career and did a lot of different types of real estate. And that was in my exploratory phase, where I was really trying to figure out what was I actually really good at. And what I found that I was really good at was residential real estate, whether that was single family or multifamily. I had a lot of success in the residential real estate space. I struggled a lot in hospitality, self-storage, development, and construction. None of those were really all that fun to me. Yeah, I didn't lose any investor money. I certainly lost some of my own. But, I found like I got to leave self-storage to you guys. I mean, you guys know that business, and that's what you found that you guys are really good at. You guys do self-storage while I do something different. So lately we've just been, I'd say the last 20 years, we've really stuck right down the middle of the fairway in our own lane in the residential space. And, another thing I learned through this process was that, you can know a lot about a lot of things, but you really need to have people that know a lot about very few things right there in your inner circle. So when we expanded our multifamily platform nationwide, I brought in guys that had 100,000 units of multifamily experience, having worked for decades for institutional shops, managing properties and owning properties all over the country. And having them on my team, not a board of advisors or somebody I could call, but I mean, on my team as part of my company that I talk to every day, really helped take that side of the business completely to the stratosphere. And now we're doing the same thing in senior housing. I've got a managing director that I've brought onto my team to manage our senior housing platform, who was the president and CEO of a healthcare REIT and has done nothing but senior housing for 25 years. Would I just decide on my own to go out and go like, oh, I think the flavor of the day is senior housing. I'm going to go give that a shot and see how that works out. That to me is a recipe for disaster. I think you circle yourself with really highly qualified, very smart people that know about the space that you want to be in. And myself being flexible and realizing that real estate is like a meandering stream in a meadow. And if the stream curves left and curves right, but all you know how to do is row straight, you're going to go right aground. You have to be able to row left and right and follow the currents. And I think all of those things wrapped up is kind of what helps you do a lot of things really well.
Quick question, and then I'll get to the follow-up question. When did you start looking at the senior housing space and kind of deciding that was an avenue you wanted to pursue?
As soon as I knew that the guy that is one of the best in this industry, I could get him on my team. That's how I had a chance to bring this guy on board, and that I've been waiting for that chance for 25 years. It just so happens that that happened at the same time that side of the business is kind of at a 10-year low. They're just coming off of COVID, where a lot of these businesses got destroyed. I mean, the disease literally killed their clients. I mean, it's not even an exaggeration. So now you've got valuations that have fallen. You've got all kinds of trouble. And, that signals to me that we're in a bottoming phase in that sector of real estate. And that's a really good place for us to be investing right now while things like our core competency of multifamily is faltering. There's just been no real reason to invest in multifamily in the last 3 years. And I don't think there's going to be any reason to invest in it for the next year or two. So what can we do when there's times like this? Well, we can do absolutely nothing, which is what we've been doing for the last 3 years. Or we can find another strategy that we think is at a bottom and get in at the bottom and ride it all the way up. And we found that strategy, and we happen to find the right person to head that up for us. And just so happens those two things happened at the same time.
So this is the second time in 5 minutes that you've described being the opposite of where the masses are, right? Now you're in a position where you are part of the demand when a lot of people are in the supply model right now because they're trying to unload properties that have drastically underperformed in a way that had really negative emotional implications for a lot of families because there were family members and lives involved in that COVID process. And it was a very tough place to be for a hard time. So all of a sudden you flipped and now you're part of the demand in a large supply environment. I find that to be very intriguing that you're kind of swimming upstream again on this. But the question I really want to ask you is about those 3 years, because something that's counterintuitive for a lot of real estate investors or developers is sitting on the sidelines, being willing to see what you saw in the market. The canary in the coal mine is telling you something's not right. You listen to your gut instinct and you unload properties, which at a time that turned out in retrospect to be beautiful timing. And then you had a couple years there where you're like, for somebody that's done so much across the space, you got a ball of capital that's probably burning a hole in your pocket right now. And for 3 years, you're sitting there deciding what's coming next. And I know myself and my ADD and my temptation would be like, oh, what's next? What are we going after? Where's the low hanging fruit? And sitting on the sidelines and waiting, I'd be really interested to hear what was going on in your brain through that time period of sitting on the sidelines. And it sounds to me like you didn't decide to make a move when you found the asset class you wanted to go after. You decided to make a move when you found the person that was best in that asset class. And it was a who, not how situation there. Tell me about those years of, okay, it's 3 to 6 months after your exit. You can see the writing on the wall is coming true. What were those couple years like? And what did you do? And how did you position yourself? And what was it like just sitting on your hands for a couple years?
Oh, it was beautiful. It was so wonderful. I played a lot of golf. I spent a lot of time. So I have a saying that people give me a bunch of crap about. My saying is that there's a good time to buy, there's a good time to sell, and there's a good time to sit on the beach. And thankfully I've got a beach house, so I spent a lot of time sitting on the beach, and it was great. It gave me time to read, give it time to catch up on things I hadn't had time to do when I was working 100 miles an hour with my hair on fire for however many years. And it was absolutely phenomenal. And it was a great, I loved it personally. And yeah, okay, is there cash burning a hole? Well, sure, but people oftentimes forget that cash is simply an option to purchase something in the future at a discount. So it's fine to have cash because it gives you that optionality. There's no rush. People come up to me at conferences and stuff and like, I need a place to invest because, I'm losing ground to inflation and my money's not earning me anything and all this other stuff. And it's like, just be patient. Something is going to come along at some point that's going to be the right strategy at the right time, and you're going to have the ability to participate in it. And if you just allocate your cash for only the purpose of, trying to avoid the pain of maybe missing out, you won't have the ability to react to that opportunity when it comes available to you. So there's no problem at all with sitting out and doing nothing for a few years. It's a great place to be. And thank God, I'm in the position that I can do it. There's a lot of people that are, in this industry that haven't been in the industry as long. And, they have to work to generate fees to keep the lights on and keep their people paid and all that kind of stuff. And, I didn't have to do that. When we sold out all of our properties, I left like 5 years of operating expenses in the corporate bank account that I did not distribute, just there to pay everybody for a few years so that we didn't have to do anything. that's a really good place to be. And it allows me to make decisions not based off of what I think I need to do for our business, but what I think is the right thing to do for our investors. And in the long run, that's really why we're in business, isn't it? And I think in fact, I was just looking at, we just had a webinar for our senior housing fund. And I was looking over the names of webinar registrants. And I found on there investors that have invested with us more than 15 times in different funds. I found investors that have been in there for over 2 decades. And, I think I took my first investor money in around 2018 or 20, no, not 2018, 1998. I'm seeing how the decades, you just lose decades. 1998. And some of those investors that were among that first batch are still investing with me today.
Well, way back in 2017, Neil.
Yeah.
Yeah.
Well, then he said 2018. And I was like, wow, what are you talking about?
I got
I got
a long time ago,
right?
That,
yeah. See, the decades just fly by.
So you've got a famous best-selling book, which actually got recommended to us just a couple episodes ago.
Yeah.
Called The Hands-Off Investor. You emphasize the importance of understanding the sponsor's track record. Could you walk us through how passive investors should evaluate a sponsor before committing their capital?
Yeah, it's funny. I'm speaking at a conference here coming up soon, and they've asked me to do a pre-conference workshop on sponsor and investment selection. It's a 2-hour workshop, so we could certainly be here for a while talking about this topic. But the short version is, track record means a lot. Moral character means a lot. Length of time in business means a lot. And people are like, well, okay, well, what about the new guy? Well, that's fine. You can invest with the new guy, but you have to understand the additional risk you're taking on by doing so. Because here's the difference. The people that have been around a long time aren't around a long time because they're flakes, because they don't communicate with their investors very well, because they're stealing people's money. The investors that are doing that kind of stuff, you don't get away with that stuff for very long. So time weeds out a lot of that fraud and, ineptitude and just mismanagement and all that kind of stuff. So longevity in business is meaningful. So that's one criteria that I look for. Other criteria is just trying to understand someone's moral character. And this is extraordinarily difficult to quantify. There's a lot of things that you can put a numerical score to, but this one really you can't. It's more about getting to know someone and gut feel. And I'll tell you kind of a crazy story. I had somebody call me up one time to ask about investing with us. And after about a 30-minute conversation of me answering his questions about what we do, finally I asked him, well, what do you do? And he says, well, I'm the money manager for, the richest guy in, this particular state, a $1 billion family office. And so anyway, he says, well, I really enjoyed talking with you. I think, send me all your information, keep me on your list because we want to watch what you do for the next couple of years. And then we'll decide whether or not we want to make an investment with you. And the part that struck me was a couple of years. And that's really interesting is that, smart money really wants to get to know someone over a period of time before they make a decision to invest with someone, because what they're really doing is they're assessing your character. Because if you have a character flaw, nothing else matters. You could find the best deal in the world, but if you're a crook or a cheat or a liar or whatever, it doesn't matter how good that deal is. So you got to look for those kinds of things. Look at their track record. What have they done? A lot of people want to look at track record like performance. Well, show me the IRR that you got, or show me the IRR that you got compared to the IRR that you projected you were going to get, because I want to see how well you underwrite. But none of that is really all that meaningful without context. Just because they overperformed and generated 30% IRRs doesn't mean they were geniuses. It just might have meant that they happened to get out when the timing was right and the market gave them a gift. And just because they got a 4 IRR doesn't mean they're imbeciles. It might mean that they survived like a really steep economic decline, but still didn't lose anybody's money and came out the other side. So It's not about returns. It's about, how they communicate, how they make decisions, how knowledgeable and skilled they are in that particular industry. And then, I'll add one extra point that is really important right now that didn't used to be as important, but look at the composition of their existing portfolio. If you're looking at somebody that's bought 90% of their assets in the last 3 years, I would really question their judgment because they got in at the absolute worst time and didn't even see it coming. On the other hand, they might also be spending a lot of time swatting flies as they deal with maturing loans, angry lenders, and all kinds of problem real estate instead of focusing their time on the assets that you're investing in. So looking at their current portfolio composition and how much of a distraction that's going to be, I think also means a lot when you're evaluating sponsors today.
Swatting flies. I love that. Yeah. Like I've got 2 young boys and rental properties that flooded recently that I'm renovating. And that's the analogy of you just saying that. I was like, that's how I'm living my life right now. I'm I'm jumping from meeting this contractor to taekwondo lessons to coaching t-ball to, this delivery didn't make it to in my personal life. And I'm like, man, I just want to be good at these projects. I just want to be a good dad. I just want to do all these things. And I feel like I'm just swatting flies. So maybe I need to reevaluate that. That hit home with me. So this is probably not, there's no way you can answer this, but I'll never get an opportunity to ask this to somebody who's better prepared to answer it. Based upon your experience and what you're seeing in the past, where we are in the cycle with multifamily right now, I know you see opportunity with the assisted living space. We've got I think they call it the golden tsunami of a lot of people aging into that space. There's clearly opportunity there. I come from South Carolina, which is a certificate of need state, and there's a lot of red tape to jump through there. But outside of that, where do you think the opportunity is, or where do you think the world's going over the next few years, or more than anything else? What else do you think is overheated? Like it felt like for a couple years there, if you're in multifamily, you couldn't miss. That was the 800-pound gorilla in the room, and everybody was making money hand over fist. And the reality is, everyone was riding the market up, and it was the few people that got out at the right time that really are the ones that benefited it, and everybody else got stuck holding the bag. And I say all the time, Warren Buffett says you can't tell who's skinny dip until the tide goes out. A lot of people got exposed, and I kind of feel like that strategy is one of those things that we've seen a lot of people's social media go dark. We've seen a lot of operators that have been around for a couple years that aren't around anymore. And it just reminds me of the saying, there's a lot of young running quarterbacks in the NFL. There's not a lot of old running quarterbacks because they've taken some risks by being high risk and putting themselves in that situation. They've taken a few licks like that. So where do you think there's any market segment that's exposed right now where it's better just to sit on the sidelines, or what are you seeing from where we are right now?
Well, you led off this question with, I'm going to ask you a question that you can't answer. And I'll say that...
Let you off the hook.
Well, it does in a way, but I'll say that there's no question I can't answer. However, there's no guarantee that my answer will be correct. And I think that's kind of how we lead this off, because you're asking me to speculate on where I think things are going, and I'm happy to do so as long as people understand that I may or may not be right. But here's what I think. I think that right now, large multifamily properties, which is my core business for decades, which I would define as, I don't know, to me, it's anything over 100 units, but to a lot of people, it might be anything over 50, let's just say. I feel that space is just virtually uninvestable right now. I see no particular thesis in which gets me excited about it. There's an old saying, I don't think it's a Buffett saying, but it's a somebody saying. Well, Buffett had a good one. I'll give you that one in a second. But this old saying says that the money that you make in real estate is created from the delta, the difference between the cap rate and the borrowing rate of the money that you're borrowing to buy that real estate. Well, what's the relationship between cap rates and interest rates in multifamily right now? Okay, you're buying at a 5 cap and you're borrowing at 6%. That means that it's upside down. And therefore, if that rule were to be true, you're automatically losing money by making that investment. So I'll throw that out there. Warren Buffett's saying was that real estate is only worth as much as the bank will loan you to buy it. Well, what's been happening in real estate? Let's look at the real estate debt. 10 years ago, you could buy real estate all day long with 75, even 80% LTV bank and agency financing from Freddie Mac, Fannie Mae. Now, if you look at the prices that sellers want and you send that to your lender for a loan quote, you're what they call coverage constrained, to where you're only getting 60% LTV, 55% LTV, 50% LTV. And that's because that's as much as the cash flow will support in debt service. Well, that should tell you that you're paying too much for the asset. If you can't get 70, 75, or 80% LTV, it doesn't matter if you want it or not. I would rather not be that high. But if they won't loan you that much, then to me, the asset price is too high. And that's where I think we are. Small multifamily, I think maybe there's some opportunity there. If you're kind of a newer investor looking to find an inroad into residential real estate, I think buying duplexes, fourplexes, 5, 10, 20 unit buildings, that's a viable strategy only because somewhere out there is that needle in the haystack. There's the tired landlord. There's the death in the family and the heirs have the property. They don't know what the hell to do with it. There's all kinds of human stories that create opportunity in that smaller space that you don't find in the larger space, which is dominated by professionals, funds, and all that kind of stuff. You don't have those kind of quintessential tired landlord stories. So I think there's an opportunity there. Obviously, I think there's an opportunity in the healthcare sector, and that's why we've gotten into it. I think in maybe a year, 2 years, maybe we'll see some opportunity return, on the large multifamily side.
What do you think about, with so many people, I don't want to say scrambling, a lot of things have already settled, but I think there's still a lot coming to fruition from people using bridge debt, mezzanine, variable rate, and things like that. What do you think about looking at the commercial debt space, a debt fund or anything like that, when so many people are part of the demand, looking at being part of the supply? What do you think about so many different debt funds popping up over the last 12 to 24 to 36 months? What do you feel about that space?
Well, I've been there, done that. I started a lending company 7 years ago with a partner and with two partners, and we loaned money to real estate investors. We were the supply, and there was a massive amount of demand. And we did $2 billion in real estate loans that we loaned to investors. And then we got noticed and got an offer we couldn't refuse from a publicly traded company and sold in, guess when, 2022, right before everything went to hell in a handbasket again. We sold and got out of that business and started up our own debt fund before anybody else thought that was cool and said they were going to do it. We started a debt fund to buy loans from our old company. And that strategy has actually worked out really well for us. And then since we've done it, everybody else has piled into the debt fund space. And so, it's, I think it was a great place to be when we started it, and it still is a good place to be. But there is more competition in that space now. So it's not quite as relevant. But the debt fund was a good place for the investor in those funds because it was a good place to be in the capital stack. When the values were falling, you don't want to be the last guy in line. You want to be the first guy in line. You want somebody else's money to be in first loss position. And that was a good thesis for being in that side. Now, I've long been one that says I hate bridge loans. I don't like bridge loans at all. And we didn't use them in the multifamily side. Thank God we didn't. Because I do still have about 1,000 units left in our portfolio, none of which are on bridge loans. And there's a lot of people that bought on bridge loans with way too high a leverage that are stuck right now. And I have a feeling that all of those are going to resolve, or not all, but a lot of those, a very large sector of those are going to suffer massive principal losses to their equity investors.
Do you see that as a scenario when you might get back into the multifamily space, or are you off into to other
Sure
things.
do.
Yep. Funny you bring that up.
Funny you bring that up. Yeah. When did I buy 500 single family homes? Oh, it was between 2008 and 2012. Why? Because there were foreclosures everywhere. And, we'll be in a really good spot to take advantage of any dislocation such as that on the multifamily side, because we're not the one on the other side of the fence with a bunch of this stuff going into default.
I think the people that have been doing this for a little while have a totally different perspective. I find that the more I get a chance to absorb knowledge from people that have been doing it a long time, I realize that I've been really short-sighted. I'm looking at cash flow and hopefully forced appreciation or natural appreciation by investing in a good area. But I'm playing checkers and a lot of people are playing chess and knowing that these market cycles that might be coming years down the road, getting prepared for that ahead of time and recognizing the waves. And it's one of those things they say that, you can't change the waves, but you can learn to surf. I feel like the people that have zoomed out and have that perspective that comes with years and decades of experience, you get to recognize those market cycles and position yourself to be patient, wait on the right wave, and catch the next one. And I think that that's something that, I've always believed that like who we are right now is who we're going to be, with the exception of the places we go, the people we meet, the books we read, the content that we consume. But there's a big part of that only comes from pattern recognition from having seen it before and the ability to zoom out and get that outside perspective. I don't think that that's something you can really get from a book. You maybe can get it from surrounding yourself with people that have done it before, but all you're really doing is regurgitating their wisdom that rubs off, really. So, yeah, that's something.
Well, drop the mic, Clint. I can't say it any better than that. You absolutely nailed it. That is 100% correct. And I didn't have this perspective when I first started in this business. I had no idea what I was doing. You're living hand to mouth, deal to deal, strategy to strategy, investor to investor. That's kind of the way you get started in this business. And then when you suffer from some sort of calamity that eventually will take place, then, you learn that you have to figure out how to avoid that kind of pain. There was a old saying from Tony Robbins. He would say in his, all of his courses that everybody is motivated only by two very simple things, to obtain pleasure and to avoid pain. And really, when you're kind of new in the real estate business, you're just seeking pleasure. You're like, I want to get the next deal. I want to make the next dollar. I want to get the next investor. I want to be a real estate investor. I want to be this investor. I want to be a developer, whatever it may be. And then you get pain and you're like, oh, that hurt. I never want that to happen again. And then from that point forward, the whole thing changes. And now everything is about how do you get pleasure without getting pain. And it completely changes your perspective. Now it's like, well, I'm not doing that. And, it's everything, I always say like, my job is to say no to everything. And you ask the people on my team, they'll tell you I'm really good at it. And it frustrates them sometimes. They're like, I got this great deal. I'm like, get away from me with that thing. I don't want to look at that. It's a bunch of crap, so that just changes your perspective. Suffering a little bit of pain will waken you up really quick.
See, Neil, there's nothing wrong with being a dream crusher. I keep telling you.
Okay.
It's my wife's nickname for me.
And
my partner calls me the Grim Reaper, because every time he brings me a deal to look at, I'm like, yeah, no, let me find a reason why I don't like this.
Yeah. Clint's the dream crusher in the short-term rental space in our community. So, Brian, what is the investment thesis that you guys have for senior living space right now?
Well, my feeling is that investors, meaning those people who fund what we do, want cash flow. There's been this series of years where sponsors have promised them, the sun and the moon, and that they're going to see all this IRR and all these returns and this and that. And a lot of that has not come to play out the way they had expected. Cash flow, on the other hand, is something that you can grade every single day, because as soon as you get that direct deposit in your account, you're like, okay, this investment is working. As long as you're really actually investing, distributing cash flow. Don't even get me started on what some sponsors are doing by distributing cash reserves to mask performance. That's a whole other topic. But assuming that you're distributing operational cash flow, this is what people want. And so our strategy on the senior housing side is, look, here's an investment that's mostly dependent upon cash flow. I did a study of a bunch of multifamily assets that I've underwritten. And I have a way of comparing or of breaking down of the IRR, how much of that IRR comes from cash flow and how much of it comes from the resale. And in multifamily, it's 60-40. Across the board, very consistently, 60% of the return comes from the sale, 40% comes from the cash flow. I did the same study in the portfolio of senior housing assets that we're buying, and it's the exact inverse. 60% of the return is coming from cash flow, 40% is coming from the sale of the property. And I think that's what people want right now. They want to see something that is tangible and they can get their hands on right away. And I think that's really important. So that was one thing. The other is buying at the bottom of a market. And, so defining what's happened in the market, what did past recent events do to the market? What does that mean today? And what is that going to set us up for tomorrow? And I think that, when I look at a timeline of kind of the market cycle on these senior housing assets that we're buying, I think they bottomed in 2023. They spent a couple of years getting their legs, underneath them and, like the newborn giraffe or whatever, trying to figure out how to stand up, and is just now standing up and is getting ready to run across the field. And that's when I want to get involved. Now, multi, on the other hand, I think, it's just still falling and hasn't quite figured out how to get up yet. And so there's no reason to chase after it just yet. So our strategy is buy at the bottom, cash flow, have great operators. We look at this business in the reverse. We don't look for good real estate deals and then try to find somebody to run it. Instead, we're looking for great operators that are running facilities really, really well. And it's not like we're looking in the yellow pages. I mean, we already know who these people are because Kent's been in the business for 25 years. He knows. We're looking for great operators, and then we're either buying facilities that they're running already or ones that they want to take over. And so that's our strategy. It's like you pointed out earlier, Clint, we're looking for the right people, and then we're seeking out the opportunities to place those people in the right position. Because this business, it's about real estate, but it really comes down to people.
Yeah, that's the resounding thing that keeps coming back and circling back inside my head is that, if I have to put a finger on what I think that you've done probably better than just about anybody else, it's relationship equity. You have relationship equity. You have identified the people that are the best at what they do instead of picking what asset you want to go into and helping, building a team around that to go after it. You're finding people that you think are the best at that thing and then creating a relationship with those people and saying, let's go after it. I'm relying on you to do that. So where does that relationship equity come from? Like, you've identified who you think are the people that are the best at what they do, and that's what you're building your framework off of. That just comes from experience and, just being out there and beating the bushes and understanding who's really good at what they do and identifying those people and be like, hey, 11 years from now, I'd like to work with that guy. Or if there's ever an opportunity to partner with this person, even if it's 15 years from now, I want to stay on their radar. That's the person I would be willing to go into battle with. How does that work?
Yeah, it's really kind of interesting. People oftentimes think that in this business, they're wasting their time when they're doing whatever it is that they're doing, right? It's like, well, why am I wasting my time flipping houses? Or why am I wasting my time on single family rentals? Or why am I wasting my time with this property management company? I should be managing these things myself. Or, what people fail to realize is that every interaction you have with someone else is an opportunity to build a relationship that you don't even know where that relationship is going to go. And so that's what happened to me. I mean, I was flipping houses, and this is, I don't know, 25 years ago. And my real estate agent that I hired to sell the properties for me had a new assistant, and that new assistant was helping me with our house flipping business. And then when I wanted to get into multifamily, that new assistant helped find the multifamily deal that I bought as a new investor. And then that new assistant left the brokerage and got out of selling real estate. And what did he go do? He went into the senior housing business as an associate of acquisitions, worked his way up to director of acquisitions, worked his way up to another firm where he became president and CEO. And now here we are full circle. And it's like, you want to get out of be working for the man and come partner with me, and we can go take this down in a really big way. That's a relationship that starts with a tiny spark, completely unrelated to where you think you're going. And you just never know where one thing is going to lead to a relationship or something else down the line, even if it's 20 years later. That's going to take your business in a direction you never even saw coming. I never saw this coming, but it all starts with something you would never suspect. And that's just how life works.
You can't answer this with the hands-off investor. That having been said, this is a book that is extremely well known, that's been around for a long time, and it's been recommended on this show several times. And as the author, you're not allowed to say that one. But outside of that, one thing we try to ask everybody on the show is, it doesn't even have to be your favorite book, and it doesn't have to be about real estate, but what's a book that you find yourself recommending to friends and colleagues over and over?
Well, none really, because I never get to read books anymore. So I'm reading so many like other things, like small, like news and all this other kind of stuff, that I haven't really read books in years. But the books that has some of the biggest impact on my life, beside the one that I wrote, is like Rich Dad Poor Dad, right? I mean, that's everybody talks about that book, but it really that had a lot of influence on me as a younger investor and learning the why I wanted to be an investor. That book was really impactful. There's another book I've recommended quite a few times over the years, and it's called Real Leaders Don't Do PowerPoint. And I don't even remember who wrote it. Really, it was a really good book, but it's all about delivering your message. How do you deliver your message? You don't just put bullet points on a screen and read off of them. You deliver your message, in a more meaningful way. And there was another book kind of related to that. It's called TED or something like that. It was written by the guy that founded TED Talks. And it's all about public speaking and presenting your ideas in an impactful way. And I think that those two books are really important to somebody in this business, because if you can't convey the message of your ideas, how do you get people interested and excited about them and wanting to invest in them if you can't clearly say what it is that you're really doing, right? If you can't summarize what your strategy is and your thought process is, as I ramble on and on and on, right? It's like, I'm not being very clear, but that's really the clear message.
I love that. Yeah, getting a common group of people excited about a core goal that they can believe in, it makes all the difference in the world. I love that. And I bet you we're 100 episodes or so in on this podcast. I bet you there's not a single person that's been on this podcast that hasn't read Rich Dad, Poor Dad. The Purple Bible is what jumped out at me in college too, right? That's where a lot of us got started. Quick follow-up on that I don't ask most people. You've been so good at timing the market. I don't use that flippantly, but being very good at judging where things are going. What are some of the other content that you're looking when you said you're reading a lot of things besides books, the updates, I don't know if they're economist or if it's news or it's behind the scenes. What content are you reading that you use to frame your mindset that goes along with your instinct?
I have some really good stock mentors that I follow, some stock related newsletters. And when you're like, oh, stocks, this is real estate. What's that got to do? Well, first of all, I actually do invest in stocks. I feel a well-diversified portfolio is beneficial to every investor. But I also think that, learning about stocks and the economy that impacts them ultimately trickles down to real estate too, and has a role to play in real estate decision making. So I actually follow stuff like that. But I also follow a lot of real estate news. Every morning I get at least 3 or 4 different daily real estate newsletters, CRE Daily, CoStar, just a bunch of different real estate news, daily newsletters. I follow just a lot of like general news about what's going on in the world and in the economy and all those kinds of things, because you have to have kind of a broad picture of like what's going on, I think, to get a real feel for what might happen next.
I love it. Well, listen, Brian Burke, founder, CEO of Praxis Capital, thank you for your time. We really appreciate it. If anybody that's listening wants to find out more about what you're up to, the opportunities that you have, or more about you or Praxis Capital, what would be the best way for them to connect and do that?
The best way is through our website. It's praxcap.com, praxcap.com. You could also follow me on Instagram at Investor Brian Burke, or you could go to the Bigger Pockets forums, connect with me there. I'm still out there answering questions, Neil. Even from back in the day, I just posted something on there yesterday. And, you can catch me at conferences. I'll be at the Bigger Pockets conference in October. I'll be at the Limitless conference in July. I'll be at the Passive Pockets conference in May as a speaker at all these events. I'm actually doing the keynote and a pre-conference workshop at the Passive Pockets Summit in May. So maybe we'll even get to connect in person.
That sounds great. Well, thank you, Brian. Really appreciate it. You give me a lot to think about, and I appreciate you sharing your experience with us today. Thank you.
It's great to be here. Thanks, guys.
Thank you so much for listening and watching the Truly Passive Income podcast. If you liked the show, if you think it would be useful for someone else, the greatest compliment that you could give us would be to share the episode. Leave a comment down below or leave us an honest review. If you have any questions, don't hesitate to let us know down below. And remember, with truly passive income comes freedom of time, place, and the freedom to pursue your higher purpose.